Joining us with market analysis this morning is Ted Seifert with Zaner Ag Hedge. Let's talk a little bit about the grain trade on Wednesday. Started off like a risk-on day, and we had some strong gains early on. The CPI data was kind of part of the reason we got that early push, wasn't it?
Yeah, it really was. CPI came in below trade expectations. They were looking for 8.7%. It came in 8.5%. So, hey, inflation might be cooling off just a little bit. And that brought a lot of strength into commodities as a whole because it put a lot of pressure on the US dollar. The dollar is down over 1,000 points at times during the day on Wednesday. And overall, if we're less worried about inflation, then we're less worried about demand destruction. So that's a good thing, right? And so markets were trying to be higher, but as we got into midday, that kind of changed a little bit.
Yeah, so let's talk about that because we've been putting some risk premium into the grain sector in part because of weather, crop ratings dropping, ideas of a smaller crop, but we are going into a report on Friday. And so we kind of ended off of our highs. Was that part of that play?
Yeah, part of it, at some point we were going to see a little bit of profit taking in front of the report on Friday. And I think when the weather forecast midday came out, really very similar to what we were seeing in the beginning of the day on Wednesday, which is for some much cooler temperatures in the 8 to 14 day forecast, that second run that sort of confirmed that. Really allowed the market to be under pressure. And once we started under pressure, those profit takers, those pre-report profit takers came in a big way.
And as far as the report, you've got average trade guesses coming in with a tightening of the balance sheet, a little bit lower yield. The question is going to be, how aggressive does USDA want to be on lowering this yield, isn't it?
Yeah, absolutely. And I was actually kind of surprised at the average trade guess not lowering yields as much as I thought they would. Basically they're looking at a bushel and a half for corn and not even a full half bushel, or not even a half bushel for soybeans, which I think if you talk to most people, they're going to suggest that yields are going to be down quite a bit more than that. But keep in mind, we're trying to guess what the USDA is going to say on a report, not what we think the final average is going to be. And for soybeans, we're looking for basically an unchanged carryover from last month, even with a slightly lower yield number. And for corn, we're looking for a little bit of a reduction in the carryover, but not a huge one. So what I'm wondering is, what if the USDA does reduce those yields more than what the trade's expecting? And then correspondingly, what do they do on the demand side of the equation? It could be a rather bullish report if those yields are lower than expected and they don't cut a whole lot of the demand out and give us tighter than expected balance sheets. But it could also be a really bearish report, Michelle, if they cut yields more than expected, but also cut demand more than expected and leave us with carryover numbers that are at or around the numbers that we saw last month, or close to what the trade is expecting on a very small yield reduction. So this could turn into a rather bearish report very quickly, even with lower yields, if they do get aggressive on cutting demand as well.
Yeah, it's always interesting to try to outguess what USDA is going to do. Thanks so much for joining us, Ted Seifert, Zaner Ag Hedge. Full analysis at agweb.com. We'll have more Ag Day coming up. Okay, we'll do the long one now. And comes in 3, 2, and 1. A mostly higher day on Wednesday, with the exception of soybeans. Ted Seifert, Zaner Ag Hedge, is joining us with analysis. We started off with a risk-on day today, Ted, and a lot of that was just that CPI data came in a little bit lower than we expected, didn't it?
Yeah, the trade was looking for 8.7% on the CPI number. It came in at 8.5%. So inflation cooling off, down from 9.1% the month before. So maybe we have seen the peak of inflation. Maybe that started taking a little bit of a turn. Either way, the dollar was sharply lower, which is an interesting development. And that is fairly friendly for commodities. And you saw crude oil, for example, down initially after that CPI number came out, but very quickly turning around and going back positive on the day. And grains markets really tried to follow, despite what was maybe a little bit less threatening forecast in the 8 to 14 day model runs, with some cooler temperatures coming into the mix. So we found strength there early in the session. As we continue to be concerned about weather, concerned about those conditions coming down that we saw, Monday afternoon, more than expected even. But then we really kind of took a bit of a turn there midday in the grains, not necessarily other commodities for the most part, closed rather strong there on Wednesday.
That's right. And let's talk about, going into the report. Soybeans came well off of their highs there. And was that just a function of some routine profit taking by traders as we go into the reports? Or was there that much of a change in that weather forecast that you talked about?
If you look at what soybeans have done since last Thursday, so in less than a week, we've rallied about $1. And with a big report coming in at the end of the week, the August report, which is a very big deal, and without knowing what that report's going to say, especially when you add the potential for some acreage changes in there, which is not normal for us. We've not seen this before. So with all that uncertainty of what the report might say on Friday, you figured there was going to be some profit taking at some point. But then, when we saw the midday weather update, which for me looked really rather similar to what we had seen Wednesday morning, again, that's calling for some cooler temperatures in the 8 to 14 day outlook, maybe a little bit less threatening than what we had been looking at. We saw confirmation of that again midday. That's what kind of triggered a little bit of a sell-off. And as that sell-off occurred, then your would-be profit takers are encouraged to hurry up and take their profits rather than wait until the day before the report. So I think those two things really kind of snowballed on each other and took away really all the gains in the soybeans and pushed us lower on the day, not by a whole lot, but we did go down on the day. Now, we did get up to our 100-day moving, or close to our 100-day moving average in soybeans. So that was a likely area for them to be taking profits anyways. So again, it's a mix of things happening there, Michelle, midday Wednesday that kind of provided that slide for the second half of the session.
Yeah. And we did get confirmation of some more of the China export business, but that had been rumored. So it was kind of buy the rumor, sell the fact again, wasn't it?
Yeah, it really was. I mean, that's all coming back to all the rumors that we were hearing last Thursday. One of the rumors that we were hearing last Thursday when we were sharply higher in beans was that China will need to buy another 1.5 million metric tons of soybeans for September delivery. We really haven't seen the confirmation on that. These sales are nice to see, but this is the time of year where we would expect China to be coming in for really daily sales like this. But if they really have this need to finish up what would be our old crop marketing year, well, where are those sales, right? And they should come in pretty big numbers if they ultimately need to get to 1.5 million metric tons. So yes, it's good to see these export sales, but I think you got to take them with a little bit of grain of salt. It is a little bit of a relief because we had gone for a long period of time where we really weren't seeing the sales and getting into a time frame where we should be seeing the sales. So yes, there is some relief that we are, but these aren't numbers you should really be super excited about, at least not just yet.
Okay. So we had put some weather premium back in the market here Monday and Tuesday in both corn and soybeans because of the lower crop ratings and the weather forecast and whatnot. And I think a lot of us are wondering how much of a reduction do you think that we're seeing in yield and how much of it is actually going to be confirmed in the report on Friday?
Yeah, absolutely. Yield's going to be the first thing everybody looks at on this report on Friday. And then we look at ending stocks, right? And then I guess maybe acreage too. So, but yield is really the big thing for this August report because the USDA is coming into this report with a new. The August report is a different yield estimate than what they do leading up to the August report. So, if yield is the same as what they were in the July report, it's just purely by coincidence. So we expect to see changes in yield on this report, and which way they're going is really very telling for, generally speaking, how we finish out the growing season as well. So yes, but kind of to my surprise, the trade's not looking for big drops in yield on this report. I think a lot of people are suggesting that yields can and maybe will drop substantially between now and the final number. But at least for this report, the trade's not expecting major changes from the USDA. Only about a bushel and a half in corn and less than a half a bushel lower in soybeans. So there could be a surprise there on yield. It should be interesting to see what happens. There's been some private estimates out there earlier in the week based on a survey that are 10 bushel an acre lower in corn. So again, there are some feelings out there that yield can be sharply lower than what the USDA was saying last month. But the expectations for this report are not for those big dramatic declines just yet.
Is there a number though that would trigger the funds to come back in here and aggressively buy or not in both corn and beans on yield?
On yield, right. So that's a really good question, Michelle. And it's one of those things where, how do we digest a report that comes out during the market, right? And if the first thing that we are looking at is yield, which I think it will be, if that yield number comes in much lower than expectations, there should be a immediate response of buying by like the algorithms and things like that. But the real question is, what does that yield do? How is it translated into an ending stocks number? Because if the USDA rips the Band-Aid off and lowers yield much below what the trade is expecting, that could be bullish or it could be bearish. Because if they also go in and cut out a lot of the demand and they end up giving us ending stocks numbers similar to what the trade is expecting on a small yield reduction, well, that ends up being really rather bearish, because then we can say, well, the yield, ultimately is going to be down a lot. Oh, but now we see that on a report. And it doesn't give us these super tight balance sheets that we're worried about. If that is the case, then you can have a bullish yield number, but a bearish reaction because of what the ending stocks numbers are.
So wheat actually had the best day, and maybe I should have started with that because of it, but because of the dollar being down as hard as it was, and the fact that we had gotten so cheap in that market, are we just seeing this market try to bottom? Was this more technical action, do you think?
I think we really overran the upside in wheat, back at the beginning of the Russian invasion of Ukraine. And a lot of that was a short squeeze. It wasn't necessarily fundamentally justified. It was because whoever was short the market, i.e. funds, i.e. commercials, had to get out, and, they was just not given a chance to do that. So, we overdid it to the upside. And then I think we really overdid it to the downside. So now I don't think you need this overwhelmingly bullish fundamental news story for wheat, because again, I do think there should be a bit of a recovery, and we've been carving out a bottom here for a little while. So with some higher row props and just from some better technicals, I think wheat has a little bit more upside potential from here. And again, I think we had just gotten a little bit too cheap there. We certainly had gotten too oversold. And with Thursday and Friday, with Tuesday and Wednesday's trade, we've broken this downtrend line. So that should offer a bit more of a technical recovery, hopefully going forward, as long as there isn't some wrench thrown into the mix, which could be, a really bearish USDA report or sharply lower row crops or something like that.
Yeah. And I think the funds had actually gotten long in at least Kansas City and Chicago futures. So probably time for them to cover some of those. Let's move over to the livestock futures, because a strong day. We had new contract highs in October hogs. How much of that was tied to outside market influence, the lower dollar, the higher Dow, and the CPI?
Yeah, I mean, I think for the most part, commodities got a boost from that. But the hogs have been just kind of on an upward march for a while now. And we've been threatening to go and make these new contract highs. We were finally able to do that. It was just the right climate, I think, to do that on Wednesday. But the hogs are an interesting trade, because I think your speculators have really caught on to the idea that it's sort of a win-win for pork, right? If we are going to continue on with this big inflation, that's bullish for really everything. That's what inflation means, is that prices are going higher. But also, if we have this sort of recessionary climate in the market, and things are going to get kind of dicey going into the fall and winter months, well, then people are going to be looking to spend less money at the grocer, and they're going to be looking for alternatives to their normal proteins. Meaning, instead of buying a 24-ounce or a $24 ribeye, maybe we'll look at the pork chops. So you sort of have this double bonus or sort of win-win situation, at least from the way the speculators are seeing it, in the hogs market and for pork demand. I think we can keep climbing higher there. It looked really good. It didn't seem like we tagged a new high and then really reversed off of it. Yeah. We were able to close up near that. So some fundamental or some technical follow through based on interesting fundamentals, I think is sort of warranted at this point.
I had to also wonder if on the hogs, last week we had good exports. China was in there buying, and I see their pork prices are up about 25%. So is the thought maybe they're going to be back in their buying too, or?
Yeah, I mean, you put that together with some fairly decent domestic demand, and then China was in for 16.8 thousand metric tons, which was a little bit more than half of our overall export sales for the week. That's great. We all remember when China had ASF and they were buying just really big chunks of pork, pun intended, on a regular basis. maybe we can see something similar to that. I mean, they certainly don't have the same issues that they had, and their domestic situation is different. But if their domestic prices are going higher, and that opens the door for them to come in and buy some of our exports, that would be great to see. And again, that really adds to the optimism that we have going forward.
And cattle cash trade higher last week. I think the idea is we're going to be higher again this week. The bid's kind of indicating that. Is that continuing to give us a push? And how much higher do you think we can go in those futures?
Yeah, I mean, higher cash is always a nice tailwind for futures markets. Certainly feeders were down a little bit earlier in the day because of the strength that we saw in corn.
Right.
But you just have this nice upward trending channel there in feeders. We respected the downside of that. So hopefully, we're looking at a bounce here in the next day or two. And cattle held fairly well for all things considered for the day. I do think there's more upside potential there. I don't know if it's profound. If I'm needing to hedge some cattle, I'm kind of looking at that here and now. Loving the idea of potentially more upside, but also a little bit nervous that at some point this can roll over. And I think a lot of that's tied into my nervousness on the economy. I think we're kind of getting lulled into just being complacent that, okay, we're moving out of the recession, and that was quick. And yeah, I don't know. I think this is just sort of a fake recovery type thing. And ultimately, I think there's some speculators that are worried about that in the beef and the cattle market as well.
Okay. Well, thanks for your insight, Ted Seifert, Zener Ag Hedge.